welcome to Informed Investing. My name is Don Lawrence. I'm the CEO of ST Research, and our platform is StockTargetAdvisor.com. I'm a financial analyst and a trader, and today we're going to talk about Twitter, the Fed, and the financial crisis. So let's start off with earlier this week we've got good old Elon coming out agreeing with the to go ahead with his 44 billion buyout deal. The share price, I believe, is around $54.20. Obviously, I believe today the share price closed around $52-ish there. So what's interesting, my sort of take on this, I think quite honestly that sort of Elon Musk's last several months was just basically a delay tactic, and he's agreed to go on with it. The reason why I believe he's done that is to sort of watch the economy weaken. Banks are getting quite nervous, and obviously it seems to be so that Citigroup, one of the banks that are financing or supposed to be financing the Twitter leverage buyout deal, is getting nervous. And I think so that was his whole idea, was to wait for the economy to get worse, and it has worse. It has gotten worse. If we look over in Europe, there's rumors that Credit Suisse, the Swiss bank, is in Switzerland. There is facing sort of liquidity issues. Obviously, a bit of concerns there. We go over to the UK. Obviously, a lot of the UK banks have not recovered to where they were from the past. Previous 2008-9 financial crisis, so they're susceptible to having more liquidity issues there. They're still not what they were prior to the financial crisis. They just have not recovered the same way. So, and we look at the Bank of England saying they're going to raise rates up near 6%. We got 40% of mortgages in the UK, mortgage holders that are on variable rates. So we just got ourselves a real disaster there with those rates rising. A lot of homeowners are not going to be able to afford their mortgages, and we might see a housing crash, and then poof, we're going to see possible financial crisis 2.0, and then obviously bleeds into the rest of the financial markets in North America, etc. So I think that sort of that premise there, that's what the banks are looking at, and they're getting nervous. And I think it's the banks that are actually going to pull out of the Twitter deal. So as a result of this sort of anxiety in the markets, and of course we see this week we see the gyration in the market when we see 2% down, 3% up, and then the market's 2% down today. Then they bounce back. So there's a lot of uncertainty, a lot of fear going on there, and I think that volatility is going to continue. The question is, I think what could help is the federal banks around the world, if they start pausing on their tightening, stop raising rates. I think that will sort of really help sort of ease the pressure, ease fears. I've said this many times before. Very, very key thing: markets do not like uncertainty, and right now we're awash in uncertainty, and those interest rates and the issues in Ukraine, the sort of the energy crisis, if you want to call it, the food crisis, all these things are catalysts to just volatility. So, we need at least one of those to kind of get taken care of. So the Feds come out and they back off on raising those rates, and hopefully inflation starts to tame a little bit, and they feel confident in pausing. Because what's going to happen is if they overshoot on those interest rates, keep pushing them, then all of a sudden you're going to see this trigger, and then you're going to get massive layoffs, and then you're going to have inflation should go down, and if it doesn't go down, then you're in stagflation, and then you just kind of want to put your hands over your eyes and just stick your head in the dirt and maybe wake up in a couple of years or so. Or if in the likes of Japan, it was 20 years that they were in a stagflationary period. So anyways, there's just a lot of financial risk going on in the markets, and we definitely could see a financial crisis 2.0. There's hopefully not, but it's just looking kind of ropey. A lot of people are sort of equating Credit Suisse to possibly a Lehman Brothers moment, what triggered the '08 crisis. So there's a lot of parallels there going on in between then and now. So let's hope that the federal banks have a little bit of sense there and kind of rein in and on those interest rate hikes and start of let the financial markets flatten and get a bit of confidence, get a bit of risk back. And as such, because right now it's this real risk off environment. It's just really a trader's environment. So yeah, so all that stuff packaged up, I think Elon Musk is going to get off free if he likes, with no liability issues, because I think the banks are going to back out. Anyways, guys, let me know what you think. You think the banks are going to bail on Elon's deal? Do you think we're in for 2008 2.0? Just throw it in the comments there below. Please check out our platform, stocktargetadvisor.com. Have a look at our premium and platinum services. Happy to help you with your investment needs any way we can. Anyways, guys, always remember that your best trade is always a hedge. Cheers, guys.